This conference will now be recorded.
Hi, what's up, everyone? This is Miali, and I'm representing ABFX. Guys, first of all, a very warm welcome to all of you in this particular webinar, and I hope that you are doing great. Guys, as you know, that is the time of the year when the markets are mostly closed, and the financial markets, financial investors, the institutional investors, all of them are out of the market because they are enjoying the Christmas holidays. But the thing is that it is the best time for us to learn the new strategies. So as promised, we are coming up with 4 webinars a week. The 2 webinars are designed for beginners, and 2 webinars are designed for professional traders. So for your information, the webinar starts from Monday. We have one beginners webinar on Monday. Then we have a professionals webinar for Tuesday. Then again, professionals webinars for on Wednesday, and then the fourth webinar, which is designed for beginners, is going to be on Thursday. So this is just like a boot camp, and if you guys are having zero experience in the market, or even if you have 5 years of experience in the market, this is for you, because we are going to scrap things from the basic, and we are going to lead them towards the advanced trading strategies. Not only that, we are also going to speak about the trade ideas. We are going to talk about the trade setups that you can take like in real time. So this is going to be fun. And yep, so without wasting any time, let's move on towards webinar's topic. Today we are going to talk about the forex market basic terminologies, and this webinar is called learning your first step. Guys, as you know that this particular webinar is designed for beginners, so you don't have to worry about it. Even if you have zero experience in the market, if you are joining the market today, you don't have to worry about it, because in this particular webinar, I'm going to answer most of the questions that I believe beginners should have in their mind. So let's move on, and let's take a look at the session's outline. That is something what we are going to discuss in today's webinar. First of all, we have what is forex market. Guys, although this is a very simple question, but there's an implication, and sometimes to beginners, I do remember that when I was newbie in the market, I used to think who are forex traders and what forex market actually is, like what kind of thing is like. So whether this is some physical market, whether this is a virtual market, what we trade in it, and why we trade in the forex market, why not trading in any other market, why not going to the market physically and purchasing the dollar, euro, Japanese yen, pound, or any other currency, why we need to prefer trading online. And what we actually trade here, this is a real question, because when we trade in the forex market, we are not getting anything. This is all intangible thing, like this is all virtual. So this used to cause me like doubt this market. I used to doubt this market, like how, when I'm not getting something, I'm paying for something, I'm investing in something, but the thing is that what I'm getting in return is nothing. I'm not getting in although we are getting profits and losses in return, but the thing is that we are not being handed over any physical thing. Like in other type of businesses, for example, if I'm investing $10,000, I do get some sort of maybe physical location. I will get an office, or maybe I will purchase something. Let's say I will purchase a car. I believe that the price of that particular car is going to be higher in future, or maybe I'm purchasing gold physically, and I believe that the gold prices are likely to rise in future. So the thing is that whenever I'm investing in the market, I'm getting something physical in return. But in this particular market, we are not getting anything in return. We are not being handed over anything physical. So I will help you out with the core idea behind trading this market, like what we actually get, what we are trading in reality. And then once you understand these 3 points, we will speak about the different types of analysis, guys. This is one of the very important thing to know. For instance, uh, I need to understand the reason why I am doing something. For instance, if I'm purchasing gold, I need to understand why. This thing is going to help you answer your question like why, and that is exactly what you need to answer yourself before investing anywhere in the market. You need to know why you are doing that. You need to know why you are specifically investing in euro, or maybe why you are specifically investing in stock market. So we are going to speak about it in this particular webinar. Then we are going to talk about the different types of currency pairs. I will help you out with this. For instance, why it is important to understand the currency pairs. Although, guys, this is something which is not very hard to understand, and or maybe you will think that this is not very important. But the thing is that it is for newbies. This is confusing. For instance, what you need to do with the euro, USD, and then we have also USD JPY. What you need to do with both of these, whether you need to buy or whether you need to sell, when there is a probability that the dollar is going to get stronger, there is going to be a different treatment for both of these currency pairs. So that is the reason why we are going to talk about different types of currency pairs, and then we are going to talk about basic terminologies. Guys, every market have their own language. For instance, if you are doing a business in the financial market, there are going to be different terminologies. For instance, if you are doing a business in manufacturing industry, there is going to be a language, jargons, different slang language, slang terms that you are going to use. So there is going to be different terms, terminologies of language, or a slang, or jargon. There is going to be different um, a sort of language that you are going to experience while you are reading news, while you are studying analysis, while you are speaking to a forex trader. You are going to you're going to see that they are coming up with a different type of different sort of professional terms. So in this particular webinar, we are going to talk about these professional terms, and these are not really hard to understand. These are very logical. I will give you examples, and this is going to be really easy for you guys. So moving on towards our very first slide. What is forex market, guys? I know that most of you know that what is forex market. Let's say I would like to ask you guys question: how many of you have ever traded in the forex market? Guys, this is going to be a two-way communication. This is not going to be a one-way communication. I will be asking questions, and you will be able to answer me in the chat box, or you can ask me question in the chat box, and you are free to ask me anytime. You can ask me questions during the webinar. You can ask me question by the end of the webinar. By the way, we do have 5 to 10 minutes of time for answering your questions. So don't worry about it. If you want to ask me questions right now, you can type it right away, or if it can wait, you can type the questions by the end of this session. So here's my question: how many of you have ever traded in the forex market? So you guys got 30 seconds to answer yes or no. All right, so it looks like we have very interesting answers. For instance, we have like couple of answers that I have never been involved in the forex trading. All right, guys, if your answer is no, um, I will ask you to think again. Because if you believe that you have never been indulged in the forex market, let me tell you that you have been indulged in the forex market. For example, like let me give you an example how you have been indulged in the forex market. For instance, if we have ever purchased anything from AliExpress or any eBay or maybe Amazon, if you have ever purchased any product from these websites, then you are you belongs to Dubai, you belongs to India, you belongs to Pakistan, or you belongs to any other Asian country, you are purchasing a product in the US dollar while your local currency is something else, maybe a dirham, maybe dinar, maybe Indian rupees, maybe Pakistani rupees, right? So the thing is that you are converting your currency, let's say AD to US dollar. You are converting your currency like while you are paying online, your bank is converting your local currency into US dollar, which means that you are involving yourself in a foreign exchange transaction, isn't it right? So it means that you have been a part of foreign exchange transaction, or in a second case, let's say have you ever traveled abroad? Let's say if you have ever traveled abroad and you are like converting your currency into the US dollar, or maybe when when you go to Dubai, maybe when you go to Malaysia, or maybe when you go to any other country in the world, what you do is you exchange your currency, or maybe you purchase the foreign exchange currency in order to spend that in the other country, right? Whenever you are doing that, guys, this is something which is called forex trading. What you are doing is you are selling your currency and you are purchasing the currency of other country. But the point is, in this particular scenario, you are not doing it for the investment purposes. You are not doing it for earning profit, but you are doing it for meeting your needs, right? So the only difference between this forex trading is whatever you are doing in this market is the main objective behind this is to earn profit, right? So okay, so let's speak about what is forex market. Forex market is a combination of foreign and exchange. Forex is a combination of foreign exchange. It means that you are exchanging your currency with the foreign currency, right? And the forex market is a place where foreign currencies are being exchanged, buying, selling, exchanging currencies at the current price. For instance, I need to go to Dubai, and what I will be doing is I will be purchasing Dubai currency at the current market price, and I will be selling my currency, which is Pak rupees, right? Whenever I'm doing that, this is foreign exchange, this is forex trading. What I'm doing is I'm selling my currency and I'm purchasing dirhams, right? All right, so that being said, there is another question, like why we trade this market. Like, guys, if I give you an example, the trading volume of foreign exchange market is 3.5 trillion dollar on the daily basis. Can you believe? And if we compare it with the stock exchange, this is like 50 times higher than the world's biggest stock exchange trading volume, which is New York Stock Exchange. Let me give you a very simple reason why is that. Like, as per my experience, guys, due to the technology, due to advancement in the IT sector, now you can trade you can simply trade the forex market from your mobile, from your tablet, from your laptop, from your system. You don't have to go to the market like physically. I do remember that my father used to go to the market like physically, and they used to like invest in dollar, and they used to invest in euro. But the thing is that they were physically purchasing it. But right now, the ease is that you don't have to physically purchase it. All you need to do is you need to open an account with ABFX, and then you will be able to trade them on our MT4 platform. So enough about it. So let's move on towards our next slide. What is it? Okay, what I like about this market, Okay, so the very first thing that I like about this market is because this market is active 24 hours a day and 5 days a week, which means that it does not ask you to like you don't have to be a full-time trader. You don't have to spend like 7 hours or 8 hours of your job on the in front of screens to spot the trading. This market is active for 24 hours. Whenever you have time, all you need to do is you need to sit in front of your system, you need to sit in front of your tablet, and you need to spot the opportunity, because this market offers endless profit opportunities every single day as a result of consistent price movement. Price is moving. Whether you are in the market or not, this price is moving. The euro is going higher, euro is falling down. Even if there is a very less volatility or thin volatility, or very like the market is lacking trading volume, still there is going to be a slight movement in the market. When there are bigger movements, definitely this is a point which we love to trade. But the point is that this market is moving always, every time. So all you need to do is you need to spot your spot these opportunities. Okay, sell here, market falls down, close your position. Market falls down, buy here, market goes up, close your position. Which means that all you need to do is you need to spot your trade opportunities, and that's it. You need to make money out of it. So this is one of the reasons why I like to trade this market. Now, the third, one of the most common question that I have answered is like what we trade in the market. Like let's say we are not. I'm opening an account with $10,000 and I am getting nothing. Right? I am getting nothing. What I see is I see my transactions on MT4. But the thing is, I'm not getting. I'm investing in crude oil. I'm investing in gold. I'm investing in stock market. I'm investing in currencies. But the thing is, I'm not getting anything physical in my hand. So we do trade derivatives. Because derivatives is a financial term which means that let me tell you what is derivative. Like I do remember that we used to study derivatives in our in our MBA classes, uh, and that there's another term also which is about derivatives. But in the financial market, the derivative is something which is saying drive. You are driving prices. Derivative is anything whose prices are being derived from any other factor. What can be that any other factor? That can be demand, and that can be supply. So in short, derivative is anything whose products are being derived from demand and supply factor. So in the financial market, these derivatives are given a name of future contracts, forward contracts, CFDs, and and yeah, this is all. And there's also swap and options are there, but the thing is that we don't trade swaps in the market. We do have options like binary options, but we are not going to speak about it in this particular webinar. So our focus is going to be, let me define what is future contracts. Because future contract is, it's a contract, it's an agreement, it's a promise between you and the exchange, that you are going to purchase euro, US dollar, or maybe 100,000 US dollar, which is one lot. You are going to, if you are buying this contract, this means that you promise that you are going to buy 100,000 US dollar, euro USD, which means euro, 100,000 euros. You are buying it now, and this, the delivery of this is going to be in 30 days, maybe in 50 days, or maybe in 60 days, because these future contracts has have a varied date in future. For example, in order to make it more convenient for you, let me tell you that the WTI, let's say, you are trading crude oil, futures of crude oil, which means that you promise that you will be purchasing 1,000 barrels of crude oil in future, in date, in like let's say today this is December, and you promise that you will purchase it in February. But the thing is that whenever you open an account with your brokers, uh, broker like there's in their agreement, broker do sign that you are not going to get anything physically, and you promise that you are going to settle these contracts before they expire, because before their expiry date. So for example, if you are purchasing crude oil, there is going to be an expiry of crude oil, because you're not going to get 100 barrels or 1,000 barrels of crude oil in your home as a home delivery. No, this is not going to happen. You have to close your position, you have to settle off your position before the expiry, so the broker will be able to settle off in the market. And likewise, same is the case with the gold and any other commodity. And yeah, the CFD is the contract for difference. You mostly trade contract for difference with the brokers. The contract for difference means that you have an agreement with broker. For example, you have an agreement with ABFX that you are going to, whenever you are going to invest in anything, ABFX and you are going to settle the profit or loss in between these transactions. So for example, if you are investing in S&P 500, which is a stock market index of the US stock market, which means that you are buying this index and the prices of that index goes higher, and you are making a profit of 1500, 1.5k. So this means that you are not going to get index in reality, but the thing is you are going to, when you close your position or you sell this contract, this particular CFD, you are going to get $1,500 or 1.5k, or you can say that the broker is going to settle off the difference between your buying price and your selling price. And this can be positive, this can be negative. Like if you purchase anything on $2,400 and the prices goes to 2,500, definitely you're going to get profit. Or in other case, if prices fell down, then you are not going to get profit but loss, right? It's logical. Okay, so moving on towards our next slide, why we trade and how we decide what to trade, when to trade in the market. Guys, the first thing is, whenever, like not only in the forex market but also in any other market, whether you are a manufacturer, whether you are a trader, like trader of any other product, let's say you are trading commodities, you are purchasing wood from one market and selling it to the other market. Let's say you are purchasing medical equipment from one market and you are selling it in the other market, so you are a trader, right? What you are doing is you are buying at low price and you're selling it at high price, right? This way you are making profit. That's exactly you need to do in the forex market. But the thing is that how you will be able to know at which price you need to buy and at which price you need to sell. So what you normally do in your business is you have your experience, you have a know-how of your market, of your like related market related to your products. Let's say if you are purchasing medical, you are a trader of medical equipment, you will be aware that from where you can purchase the medical at the lower prices and where you can sell it at the higher prices. So that is your knowledge, so that is your analysis, right? What you do is you conduct your analysis, you determine the time of your purchase. Like for example, in December, maybe you think that in December the sales are going to be higher because of Christmas, or maybe in December the sales of your business are going to be lower because that your product is of different nature, right? So that being said, in the forex market, we do conduct the fundamental analysis. We do market analysis, and there are three different types of market analysis. The first one is fundamental analysis, the second one is technical analysis, the third one is sentiment analysis. Guys, we will have more sessions on, like, detailed session on how to conduct fundamental analysis, or what it is actually, and how to conduct technical analysis, and how to conduct the sentiment analysis. But right now, let me give you a really quick overview of all of them. So for instance, if you are looking to the only thing that you try to do whenever you are in a business, you want to predict the future. If you know what is likely to happen tomorrow, you will be able to make best decisions of each and every of your trade, right? So same thing uh, that we do in the forex market, we try to do in the forex market. For instance, what I try to do is I try to predict the dollar price in advance. I try to forecast what is likely to happen tomorrow with US dollar, what is likely to be the price of euro tomorrow, or maybe what is likely to be the price of gold tomorrow. So there are three ways to predict these prices. So the very first way is fundamentals. Guys, as it is clear from the name of the analysis, it is fundamentals. It means that we try to forecast future prices based upon the past prices. Oops, not this is not right. This is about technicals. So whenever we try to predict the future prices based upon the events in the market, anything which is happening in the market. Let me give you an example. For example, um, the trade war, between USA and China. This is hurting not only the US market, not only the Chinese market, but also the US markets, right? Not only the US and Chinese market, but also the European market. This is also impacting gold. This is also impacting dollar. This is also impacting Chinese yuan. So if I try to predict the future prices of any commodity, any stock market index, or any currency based upon this event, this will be called fundamental analysis. Right. Secondly, we have like technical analysis when we try to forecast future prices based upon past prices. Uh, as per Warren Buffett, who is one of the expert in the financial market, he is a pioneer in the technical analysis. He says that market follows past, like there's a trend in the market. There is no random walk hypothesis. Random walk hypothesis means that prices moves randomly. There is no trend in the market, but no, actually there is a trend in the market. For example, uh, this is how market moves. Let's say if the gold price is $1,200 per ounce on Monday, on Tuesday the prices goes to 1210. Sorry, 1210. On Wednesday prices moves towards 1220. On Thursday prices moves towards 1230. So what do you think, what is likely to be the price on Friday? Looking at the trend, you will say that the price is likely to be 1240, right? So this is how we try to forecast the future prices based upon the previous prices. Although the example is a bit easy, but the thing is that in the actual market, in the real-time market, this is going to be slightly complex, but this is not something which is impossible, right? We are going to speak about uh, number of technical indicators. We are speak about number of fundamentals which we need to learn, which I will be helping you out. Me and my team, like, we all are going to help you out with these strategies, with these fundamentals, and we will make sure that we like once you are with us, you are learning each and every thing that is required to predict the market, and you should be able to trade on your own. So this is only possible if you ask questions, if you join webinars, and not only joining webinar going to work, but also you have to participate in the, like, your participation is going to be in the form of questions and maybe in the form of answers. So This will be like more easy way for you to understand. And the last thing is going to be market sentiments. Market sentiment means we have to understand, we have to predict what most of the market participants are thinking about particular commodity. For example, we have a interest rate decision by the end of the month, and we believe that the Federal Reserve is likely to hike the interest rate, and dollar can get stronger on Friday. So it means that if 70% or 75% of investors believe that dollar is going to be stronger on Friday and today is Monday, I will try to go for buying opportunity. Like I will be purchasing in advance, right? So this is called a sentiment analysis, where we try to understand what every other member in the market are thinking, and based upon that thinking we jump in the market to capture whatever we can, right? So guys, with that we are going to take a quick break for 30 seconds, but in that particular break you guys will be required to ask your questions in the question box. Just feel free to share your questions in the question box. If you have any ambiguity of whatever we have discussed until now, we are going to talk about it, and then we will proceed further. So yeah, you can share your question box in the chat box. All right, fellas. Thank you so much for your comments. I really appreciate it. And now we are going to talk about what is currency pair. Guys, in the forex market, like not only in the forex market but also in any other market, we have to give something to get something. For example, I want to purchase an iPhone, right? There is going to be an exchange rate for an iPhone, right? Let's say if I am purchasing iPhone, I what I'm getting is I'm getting iPhone, I'm getting mobile phone, but what I'm losing is I'm losing money. I'm giving money in return. So which means that iPhone has an exchange rate. Just like that, we do trade. Whenever we trade in the forex market, we are uh, we are trading two currencies. We never trade in a single currency. For example, if you say that you have invested you purchased dollar, you bought dollars, it doesn't mean that you didn't give anything in return. You gave your currency in return, right? So the in the forex market, we trade uh, in the form of pairs. For example, if I am looking to purchase euro, and if I'm from USA, I will be giving US dollar in return to purchase the euro. Just like that, if I'm purchasing the US dollar and I'm from Switzerland, I will be giving Swiss franc and I will be getting a US dollar. Just like that, if I want to purchase, let's say, a laptop, and that price is quoted in US dollar, like let's say this is a $1,000 worth laptop, what I'm getting is I'm getting a laptop in return, and I am giving out $1,000 to a shopkeeper, which means that there is going to be an exchange rate, right? So likewise, whenever we trade in the forex market, we are buying and selling simultaneously. When we are buying something, in on the other hand, we are selling something. Although we don't have any intention to sell it, but the thing is we are selling it, right? So we have to understand what determines the exchange rate. Like, how do I know that? Um, let me give you an example of iPhone first. iPhone to US dollar, right? This is a currency pair. This is a pair. On one side we have iPhone, on the other side we have a dollar. How do I know whether the prices of the iPhone are going to go higher to $1,200, or they are going to fall down to $950? How do I know? If I know that, what I will be doing is I will be purchasing. For example, if I believe that as per my analysis, the prices of iPhone are likely to rise towards $1,200, a pair, $1,200 a phone. So what I'm going to do is I'm going to purchase as much iPhone I can at $1,000 to sell them with $200 profit. Let's say if even if I sell 100 pieces, what I will be doing is I will be getting $20,000 in profit, right? So that's exactly what we do in the forex market, and that's exactly what we need to understand. Uh, and we need to predict the exchange rate between these currency pairs. So moving on, the demand for the exchange rate of these currency pairs is being determined with the help of their demand and supply, guys. And we always determine exchange rate. Even in the barter system, we used to determine the exchange rate, like how many kgs of wheat I need to give to get meat, or maybe how many coins of gold I need to give in order to buy food, or maybe to buy house, or maybe to buy something, anything else. Likewise, even in this particular case, we if we are looking to determine the exchange rate of Euro USD or USD JPY or maybe GBP USD or gold US dollar, uh, everything depends upon their demand and supply, right? So so the demand of first currency, and the supply of first currency, and then the demand of second currency and the supply of second currency, these are the four factors which influence the exchange rate. Like euro, when we speak about euro, US dollar, the exchange rate between this particular currency pair depends upon the demand of euro, the supply of euro. If let's say the demand of dollar and the supply of dollar, let's say if there is a high supply of euro in the market, then the more supply means that the price of that particular commodity or that particular currency will fall down, which means that if there's a higher supply of euro in the market, euro will get weaker and the pair will go down, and vice versa. There's going to be an opposite case in case we speak about if the dollar is getting weaker or if the euro is getting stronger, right? All right. So guys, speaking about the base and core currency, Uh, the base currency is the first currency in a currency pair is a base currency. For instance, in this particular study, we are speaking about GBP USD, and in GBP USD, the GBP is a base currency and USD is a quote currency. So base currency or a currency you are buying when you trade the pair. For example, if I say that I just uh, bought GBP USD, it means that I bought GBP and I'm selling USD in return, right? On the other hand, if I say that if I'm selling GBP USD, which means that I am selling GBP and I'm buying USD. Whatever I say, this applies to the first currency. If I say I'm buying, it means I'm buying GBP and I'm selling selling USD. If I say I'm selling this currency pair, which means that I'm selling GBP, and definitely I can't sell GBP and I can't sell USD. I will be buying, I will be getting US dollar, right? So the currency that we are selling to purchase the base currency is called quote currency, and the first currency is definitely the base currency without any doubt. So moving on towards the next slide. Guys, another important thing that you are going to like here in this market is bid price and ask price. So bid price, as simple as that, is the best price at which you can sell the base order to buy quote. Let me make it simple for you. It's the selling price, and the ask price is a buying price. You can take it in that particular sense. Let's say ask price is something which broker is asking you to sell something. Let's say you say that I want to purchase euro, and broker is asking you a price. it means that this is a buy price for you. You will be buying your product at the ask price. So ask mean broker is asking you for that price. If you are going to buy something, broker is asking you a particular price, right? So if you're selling something, whenever we have a selling in the market, uh, people do bidding, right? Whenever someone is bidding, it means that they are bidding on your selling product. So bid price is something like it's a best price at which we can sell the base order to buy the quote order, right? GBP USD. If I'm selling it, it means that I will be selling it on the bid price, and what I will be getting is I will be getting the USD in return. So, guys, the difference between there's always going to be a difference between bid and ask price. Definitely, this is obvious, right? Like, for example, if you are doing any business, you are purchasing a product from one market and you are selling it in the other market, you are not going to sell them on the trade them on the same price. There is going to be a difference. Your buying price is going to be lower than your selling price, right? So this is called spread. So this is how brokers are likely to make funds. For example, here this is also called broker's profit. Like this is a bid price and this is a ask price. When you buy, you will be getting you will be buying at 1.1198, while when you will be selling, you will be getting 1.1195 and 98, which means that the ask price is always higher than the bid price, right? Broker is always buying at lower prices and always selling at the higher prices, and that 0.0003 is going to be the spread of the broker, is going to be a profit of the broker, or you can say commission of the broker. So guys, I believe that that's pretty much it for now. And if you guys have any questions, just feel free to share with me in the question box. You guys got 30 seconds to do so. By the way, in our upcoming webinars, we are going to speak about the types of currency pairs, and then we are going to also take a look on the other terminologies which are being used in the forex market. So, all right. So it looks like we don't have much questions now. Thank you so much for the feedback, and I hope to see you again in our next webinar. Until then, take care of yourself and don't forget to subscribe to ABFX. Uh, that's it. So see you guys again in the next webinar. Have a good vacation. Bye bye.